If a mortgage sounds too good to be true, it probably isn't cheap. It's just expensive in a way no one explains until it's too late. Because the most expensive mortgage most buyers ever take is the one that looks like a deal on the surface. Like the builder incentives that feel like free money. You know exactly what I'm talking about. The builder's special financing. In this special episode of the Martini Mortgage Podcast, I'm going to show you why those offers quietly cost buyers more, sometimes tens of thousands of dollars more, without them even realizing it. And if you're thinking about new construction, stay with me. This could save you from making a mistake you cannot refinance your way out of. Now, before I unpack this, I need to make the compliance team happy. I'm Kevin Martini, certified mortgage advisor, producing branch manager, NMLS 143962, with the Martini Mortgage Group at Gold Star Mortgage Financial Group Corporation, NMLS 3446, equal housing lender. This podcast is for educational purposes only. It's not legal or tax advice. Now, with that out of the way, let me be clear. I'm not talking about bad decisions. I'm talking about emotional decisions made with incomplete information. Because most home buyers who fall into this trap are very thoughtful. They compare rates, they negotiate price, they do their homework. But here's the problem. Builder incentives are designed to feel simple, and simplicity feels safe. Here's the lower rate. Here's the help with closing costs. Here's a lender to work with who makes it easy. So no spreadsheets, no competing quotes, no friction. And when you're already juggling floor plans, timelines, deposits, inspection, and life, that ease feels like relief. That's exactly why this works. Here's the truth most buyers have never heard. Builder incentives are not discounts. They are reallocations. Let me say it again. Builder incentives are not discounts. They're just simply reallocations. Let me make this tangible because this isn't a new concept. This sales tactic comes straight out of the automotive industry. Have you ever noticed how the price of a car almost never goes down? Instead, the sticker price goes up. And then they add incentives, cash back, special financing. It feels like a deal, but the price was adjusted first. Builder incentives work exactly the same way. The money doesn't disappear, it just moves. Instead of paying it as a fee, you're paying it in the price, or the rate structure, or the loan terms, or the future flexibility that you give up. And sometimes you're paying with all of them. Builders don't offer incentives out of generosity. They offer them to protect margins, control timelines, and keep deals moving, especially when demand softens. And this is where the mortgage changes roles. It stops being a financial strategic decision for you and becomes part of a sales strategy designed to move more inventory. Let's talk about the shiny headlines. The 3.99 rate, the 4.5 teaser rate, the temporary buy down that feels like you're winning a lottery. What rarely gets explained clearly is this. Is the rate permanent or temporary? How much did it cost to create the rate? How much was the home price adjusted upwards to fund it? And what happens after the incentive period ends? Most importantly, what is the home worth in a couple of years since you overpaid when you purchased it? Because many of these offers rely on rate buydowns, not true market rates, which means someone paid to lower the rate. And that someone is almost always you, just not all at once. Here's how this usually plays out. Buyers focus on monthly payment because that's human. And during the incentive period, the payment looks great. But behind the scenes, the purchase price may be higher than comparable resale homes. The loan may carry higher embedded costs. The loan term rate may be above what the market is actually offering. And the break-even math often doesn't work. So while it feels like savings, the total cost of borrowing is often higher. That is why I say money in real estate is made when you buy, not when you sell. And the mortgage structure is part of the purchase. This is the part that surprises people. New construction looks pristine, but right now, it's often the highest cost you can actually buy a home. Not just because of the upgrades or the options, but because pricing's already baked in. Builder margins, sales concessions, sales commissions, incentive funding, rate manipulation, and no negotiation leverage. And when financing is tied directly to the builder, you lose something incredibly valuable: independent price discovery. You're no longer comparing an apple to an apple. You're comparing a story to a spreadsheet. Now, let me pause to be fair. The builder lender isn't evil. They're doing their job. But their job is not to optimize your long-term financial outcome. Their role is to support the builder's sales process. At the end of the day, the builder is their client. You're not their client. That means prioritizing speed over structure, approval over optimization, incentive over flexibility. They are aligned with the transaction closing, not necessarily with you winning. That's not a moral judgment. It's an alignment. And alignments matter. A good mortgage isn't the lowest advertised rate. A good mortgage is the lowest total cost of borrowing, the right structure for your timeline, flexibility for future refinancing, no hidden premiums baked into the price, option not locked in. Sometimes that means taking a slightly higher rate today with a clearer loan and a smarter exit strategy. Because the best mortgage strategy is rarely the loudest one. Here's the fastest way to tell if a builder incentive is real. Ask one simple question. Can I use this incentive with any reputable lender I choose? If the incentive is truly a discount, if it is generally coming from the builder, if it is not tied to a margin strategy, the answer will be yes, without hesitation, without conditions, and without pressure. But here's what usually happens. The incentive only works if you use their lender, their financing, and their structure, and their purchase price. And that tells you everything. Because the incentive disappears the moment you bring an independent lender. It was never a gift. It was built into the deal. When the incentives are restricted to one lender, the cost is buried in the price. The rate is engineered, not earned. And the terms are optimized for the builder, not you as the buyer. Which means you're not getting a deal. You're buying a more expensive house packaged to feel affordable. And this is the part buyers don't realize until much later. You don't see an overpayment line item on the contract. You feel it slowly over time. Higher purchase price, no negotiation leverage, higher true cost of borrowing, fewer clean refinance options later. So while the new construction looks shiny right now, in this market, it's often the most expensive way to buy a home, even when it's marked as the cheapest. Let me say it clearly because it matters. New construction is not a deal. It's a packaged deal. The incentives sound good. The payment looks attractive. The presentation is clear. But compared to a well-negotiated resale, you're often paying materially more for the same square footage in the same market with less flexibility. This doesn't mean new construction is wrong. It just means you need to know this before you start looking, not after you're emotionally committed. Here's what I tell home buyers. You don't need to fight the builder. You don't need to walk away. You don't need to say no. You just need a second opinion from someone who isn't paid by the builder before you sign the contract. Someone who can run the numbers both ways. Someone who can strip out the marketing. Someone who can show you, not tell you, what each option actually costs you over time. Because when you see the math side by side, the decision usually comes obviously. And almost every buyer who does this says the same thing. Why didn't anyone explain that to me sooner? The answer is very simple. Because explaining it doesn't help the sale, but explaining it protects you. The most expensive mortgage you'll ever take is the one that looked cheap because no one showed you the full picture. Get clarity first, then decide. That's how you win quietly, confidently, and how you win for the long term. Thank you for tuning in to episode 235 of the Martini Mortgage Podcast. I'm Kevin Martini with the Martini Mortgage Group, and you can reach me personally by dialing 919-238-4934. If this episode brought you value, please share it, subscribe, and stay connected. I look forward to talking with you and helping you get closer to homeownership with clarity.